I'd like it medium.
Prime or fillet. It's a fillet, by the way.
Grilled filet.
Steak for me.
I'm going sea bass though because my cholesterol apparently is too high.
Oh, dude, I don't have that problem.
Yeah. Have you been to the doctor though in the past 5 years?
Bro, when I go to the doctor, they're like, how can we replicate you genetically and make more of you? That's what they say.
Did they actually take your blood though, or you?
They do everything.
Yeah. Okay.
Welcome to Financial Detox. I'm Jason Labrum in studio with Alex Klingensmith today. How's it going, Alex?
It's good. You threw me off this time. I was supposed to say my own name or not.
We never know. We never know whether I'm going to go. It's all Jason right. Labrum and
it's one of those days. Alex Klingensmith.
Yes. There we go, right? We're going real estate today. It's time to revisit real estate. It's been interesting, very interesting run in the real estate market. And what Alex, I think, is going to be so interesting about this show and talking about real estate is so many people don't understand all of the different asset classes within the asset class of real estate. And you look at primary single family residence and how those values have behaved and performed over the last several years, and then compare that and contrast it with commercial real estate. Everybody knows office has been really challenging since COVID, but also other commercial real estate like multifamily, industrial, specialty, healthcare, retail, lots of other things going on. So I think it'll be a fun show to unpack this a little bit. And maybe there's some opportunities sitting in front of us right now too that are rarely presented in such strong fashion.
Absolutely. I think anybody who owns real estate in any way, shape, or form, or is thinking about buying it in any way, shape, or form, whether it be public markets or private markets, should follow us, should take us up on our offer, which is going to be talked about right now. I think, Jason, right? It's a good idea to start and end with the same thing, which is our team at IDA Wealth is expertly, objectively trained and prepared to help you analyze your real estate holdings, whatever they look like, however they look like, and to help you hold you accountable to what your goal is with that real estate, meaning that it's supposed to make money. It's supposed to be a good investment and not something that you're just emotionally attached to, or something that you maybe even hate might actually turn out to be something good. So we would love to take you up on that offer to analyze your real estate and give you a second opinion about it and see how it integrates into your overall portfolio. If you just email jason@financialdetox.com, we can get you hooked up with a conversation to start that.
Yeah, and it's pretty interesting the results we see when you're running a full cash flow financial plan, Alex, right? And you look at every bit of cash flow that comes from a real estate, every bit of associated expense, how that ties into your whole life financial plan and your other portfolios and other opportunities with your money. A lot of times we see people own real estate as an investment property, which we think is great. We're big fans of. However, a lot of people don't do it in a professional way. And when you don't do it professionally and you run the numbers and look at the yield, the cash on cash yield on the amount of equity you have in those properties, oftentimes it's dismal and you could be doing much better with the money. So that's maybe the downside is you own it and you think it goes up and it does, and maybe the mortgage is being paid. But if you have $1 million of equity in a rental property and your net after all expense cash flow is $10,000 a year, is that a really good yield, or is that actually, a 1% yield that doesn't look too great?
Yeah. Let's start by talking about the two different, most simple forms that I think most people are used to talking about, which is you've got your home, your single family home, and what's happened with single family homes over the past maybe 2 to 3 years. Let's just smaller time frame just for memory's sake, compared to this other type of real estate that you're talking about. Let's talk about multifamily, for example, which you also call commercial, which also can be confusing, right?
Right. I think commercial encompasses the whole umbrella, everything underneath the umbrella of non-primary residence, single family homes. Because you could have commercial if you bought a whole bunch of multifamily or a whole bunch of single family homes, but you bought them institutionally. I mean, I would dare say that even steps into the commercial space. Maybe not as much so. That actually might be a hybrid in between the two. Geez, everywhere I look, Alex, primary residences and single family homes, they're at all-time highs for all intents and they don't
Yeah.
seem to be off their highs at all, right?
There's not a lot of supply. I mean, we have to be very probably specific about the fact that we do live in Southern California, coastal.
Yeah.
So there's parts of the country where this is not the case. And so know that part as well, that you can't just make a blanket statement on single family homes across the whole country. You have to say, okay, certain parts of the country have this demand that will never go away. And so when that happens, if there's not a lot of supply in these areas, but there's a lot of demand, and then there's also interest rates that really are a big factor in this, right? Borrowing rates. A lot of people are locked into their 3% mortgages still, or sub 3, even for some lucky folks.
Right.
It's become an interesting thing. More and more people wanted to move here when COVID hit, out of the big cities. And so they were paying these premiums. Well, to us, they're premiums. To them, they're like, it's not that expensive compared to these big city prices. And then it kind of brought us to a new level of pricing in this part of the country. Other parts of the country too, right?
I think people realized how good it is to live here in San Diego, and how good it is to live in maybe certain parts of Texas, or how good it is to live in certain parts of, maybe it's Florida, maybe
Idaho
it's
too, right?
Idaho, maybe it's Eastern Washington, Eastern Oregon. It just seems like everywhere I go, I talk to people about real estate and single family homes in that area, and they're at all-time highs, and there's been tons of people moving there. Like, where's everybody coming from? Every place is booming. So I think it's really, you mentioned it earlier, the big booming metropolis cities, right? San Francisco, New York, Chicago. There was an exodus from COVID, and that, I don't know that exodus has really stopped. I think now, with the more of a flexible work schedule that some people have, or just the power of virtual meetings. I mean, the way we record this podcast is just at our desk virtually, and here we are live on a camera, don't have to go to a studio. I think that has prolonged or proliferated this move to the place you really always wanted to live, and the place you want to have your life, and you can now live there and work there.
I think there's also
different.
I think there's also an element that's continued to sustain this in these areas that are desirable, is that smart money is moving there also. Meaning that if you aggregate groups of capital into private equity, for example, and you buy up a bunch of single family homes in these desirable areas, going back to what we kind of started with, if you're being intelligent about how you invest your money, and you're doing it not to live there as a dwelling, but to make money, whether you're flipping it or whether you're renting it out at a premium, which is what you can do here in these areas. I think that a lot of private equity money has also been sustaining these different parts of the country. And also, not to pick on you too much, but you don't travel to the places where the housing is expensive, probably for vacation. I would guess, like, you're going to some of these nicer places like Park City maybe, or in Idaho, some places where it's just nicer. The parts of the country I don't think where the single family has done super well,
right,
aren't probably vacation destinations necessarily, right?
Yeah, they're not. And you're starting to see softening across the board. I think even in places like Southern California, you're seeing homes sit around a little bit softer, not much, but let's contrast that with the news that if you owned multifamily, or you invested in a fund, a diversified portfolio, professionally managed, which has been really the best way to create, a lot of times, the biggest yield, not always, but that has been under huge duress. I mean, it's almost a bottom. You're almost picking a bottom when you look at multifamily, industrial, those particular asset classes. In fact, we have a quick chart. This is from one of real estate partner fund. So not telling you to buy this fund, not marketing this particular fund, but this chart talks about just how real estate values are approaching the global financial crisis lows. But that's totally in contradiction to what we just said, where real estate values are at all-time highs. And what is the difference? Well, it's the different asset class within real estate. So one piece of real estate, one asset class is doing well. It's kind of like, I guess the analogy could be when you look at the NASDAQ has done so well for 10 years, and tech stocks and the Magnificent Seven have done so well. But yet, if you go back to 2000 or even 2009 to 2017, there were sometimes 10 and 20, not 20, I think 15 or 16 was the longest, but let's just call it a 15-year stretch where if you owned the NASDAQ, you were negative, you were underwater, but yet people have been pouring into that. So different stocks do well at different times. Why we talk about asset allocation all the time, and having your money not in one particular sector or asset class. But the same is true of real estate. Here we got it. We got real estate for families and single family homes at pretty much all-time highs. Real estate for multifamily, industrial, and commercial funds, diversified investment pools are literally at the global financial crisis lows. This is crazy. It's hard to wrap your head around that.
It's frustrating too as an investor. Yeah. We obviously are we're in the trenches, I should say, with our advisors, helping them talk through these concepts with clients that expect real estate to always be stable or up. And then if you go back to the past year and 2 years even, it's one of the few asset classes that's actually down. So you're looking at your portfolio, you're like, wait a minute, like all these stock market, asset classes and factors have been really positive over the past 24 months up to the end of last year at least. Yep. And then real estate is so negative. You're like, what? Why? What is this, right? And the reasons I think are important to talk about here, so that as you're an investor, you start to pay attention to them and understand them for what they are, right?
Yeah, so let's look at valuations. And producer Brian, it's like our third chart I think we put in there. You look at valuations in direct commercial real estate, and commercial again being the bigger umbrella that encompasses industrial and multifamily and retail and specialty healthcare and all that kind of stuff. But when you look at the valuations compared to maybe high yield bonds, also attractively priced, but you look at REITs, not that attractively priced, historically speaking, and the S&P 500, certainly expensive and not attractively priced. So there is an opportunity, right? What we like to do at IDA is help people trim profits out of things when they're doing really well, AKA when they're at all-time highs. And we like to buy things when they're cheap. Think Warren Buffett. When others are greedy, be fearful. When others are fearful, be greedy. You want to buy things cheap. You want to sell them expensive. That's buy low, sell high is the whole thesis here. And when you start looking at the opportunities right now in this commercial real estate place, what I'm hearing I'm hearing and seeing things that are starting to look pretty compelling to me as an opportunity to go and get basically increase the allocation to real estate. Do you think that makes sense, Alex?
I do. I think so. I'm going to play devil's advocate for hindsight here. So like 3-4 years ago, when we were doing due diligence on private real estate investments and funds and even direct opportunities as a limited partner, the forecasting, no one's forecasting had interest rates doubling or even tripling in certain situations due to readjustments. And so most people, let's just back up for a second and simplify this borrowing concept.
Right.
When you go and buy a house, I think the most conventional way to do it is to use a 30-year fixed loan, maybe a 15-year fixed loan. And you're going to get an interest rate that's fixed, guaranteed fixed, I think, right, is the contract with you and the bank for that period of time. And so that's nice, peace of mind. When you go and you buy a multifamily building, or you're part of a group that's buying it, pooling money, you're not borrowing that way, right? You're borrowing it in like a 2, 3, 4, 5
3, 5, maybe you get a 7 or a 10 if you really push it out. Yep.
And then when that term comes due, you're subject to whatever the interest rates are at that time. So people that were buying these things 3 and 4 or 5 years ago, they weren't expecting COVID. They weren't expecting interest rates to double, right? Because of COVID and the impact on inflation and on interest rates.
And easy monetary policy where we pump a bunch of free money into the system and that creates inflation, right?
I should get you started on that one. No, hold on. So stay on this. Hold on. we can go on that tangent if you want in a minute, but it did happen. So if people's forecasting got completely blown up, and add insult to injury, your interest rates went up, meaning that your cost of operating that property went up because the borrowing cost went up.
Yep.
And then even worse, rents started to go down or to zero because of this, again, certain parts of the country favoring renters versus landlords versus owners, which is really insulting when you think about it. If you own a property and you have millions and millions of dollars on the line and you expect people to pay your rent, and then all of a sudden you don't have that, it's like having a business with no revenue. It's crazy.
Well, and it's people still picking up goods and services from your business, but just deciding they don't want to pay because they can't. And then the government telling you, that's too bad. You have to continue to provide goods and services for no cost. It's indentured servitude. It's not okay. Right. And that went on across the board. But so what I think you're saying and what we're talking about here is, in general, real estate, commercial real estate was hammered because they're typically shorter term loans and because interest rates went up. And that's how real estate, commercial real estate is priced. It's an income play. It's not a home, a dwelling you're going to live in and raise your family and live there for 10, 20, 30 years. This is a play on making money. How much income can I derive? And so when interest rates go up and the cost of owning and managing that property go up, then the income goes down, that property becomes worth less. So therefore, cap rates, the rate that you expect to earn on your money, adjusts, and as cap rates adjust, that's because the price of the real estate has gone down. That has happened. That is real. If you own private real estate funds, you maybe have experienced the manager saying to you, "Hey, we need more money because we actually are refinancing, and if we don't put cash in, this thing's doesn't work." Now there's no cash flow and it's negative cash flowing, and if it's negative cash flowing, then we're going to have to get capital calls from you. So there's all kinds of challenges. I've had a lot of clients say to me, "Hey, I own this investment over here, and they're asking me for more money." And I mean, it's a really tough situation, right? You made an investment, expected a rate of return, and then 5 years later or 2 years later, you get a call saying, "Actually, we need more money or your investment's going to go away."
And the psychology of investing, the simple psychology of investing is to sell things that we don't like, which is,
right.
If the asset class is something that is permanently part of a portfolio, I mean, it's a forever thing. It's not going away. It's actually a really good thing in certain time frames. The windows of time are really, really good. Just after COVID, for example, it was really, really good. And then all of a sudden, the delayed impact of COVID really hurt it. But if you go back 10 years, 20 years, you want real estate in your portfolio. But you also want to understand how much you should own as a relative percentage of your overall investment portfolio, your overall net worth even.
Yep.
And then you also probably want to have a really good process, Jason, which I'm going to get you going on tolerance band here in a second.
No,
when do you buy more?
I'm not going to bite.
You're going to bite. You have to because it's on sale. It's on sale right now.
No.
It's a discounted price, the value of these properties. So how do you get into it right now? If you think real estate's good, if you own a little bit or none at all, or even a lot, like what do you do right now?
Well, there's two ways to own commercial real estate, and I'm going to put commercial in that bucket. I kind of by default am excluding office from that right now because I think office has perpetual long-term challenges that are I don't know how. I don't even see the light at the end of that tunnel. So commercial X office.
That's bleak. That's bleak.
If you want to own commercial X office, there are two ways to do it. One, you go out and buy the property yourself, right? You get financing and you invest in a property. Now you have to have property managers or you have to manage it and do that. The other way is through a fund, a diversified fund. There's public REITs too, actually. So there's three ways. You can do it publicly through publicly traded vehicles. You can do it yourself, or you can do it through privately traded vehicles, private investments. And those are all good ways to do it. Like we just saw on the chart, though, REITs are not cheap right now because they're like a predictive mechanism, just like the stock market is, right? The stock market is a predictive mechanism, meaning that it's pricing what's going to probably happen, the most highly probable outcome in 2 months, 3 months, 6 months. That's what the market's pricing in today. So real estate, if you look at the REITs, which would be also a leading indicator that the REITs have done really well, public real estate. But yet private real estate is still, I think, just forming its bottom. Yeah. So that would be the place that maybe has the most opportunity. Maybe, no guarantees, who knows? But it's interesting. And we've owned private real estate for our clients, some public, for a long time. And right now we're on the precipice of allocating more to that. This is not an endorsement of any single fund or single investment opportunity, just saying that there is an opportunity to allocate to something now that is historically pretty cheap for where it lies in comparison to other asset classes.
Well, just like anything else in our portfolios that we manage on a daily basis, looking at asset class movements, and we're gonna sell what's gone up too much, bring it back to its target weighting, and we're going to use that cash and buy whatever's on sale the most.
Look at you, tolerance band rebalancing guy.
I didn't say the words though. I didn't say it.
Say it.
So like small caps relatively down quite a bit this year compared to some of the other, stock index or stock asset classes or factors.
International's up and NASDAQ's down, right?
Yeah.
Total reversal. This is why asset allocation matters. It's why the way we rebalance matters under our proprietary rebalancing strategy and algorithms. It allows us to I mean, I got to be careful saying this from a compliance standpoint because nothing is guaranteed, but it really does allow us to unemotionally sell high and buy low. How about Brian, I think it's our 5 chart, but if you look at like construction starts and real estate deliveries, and then we'll bring this to a pretty quick wrap here, but just what's driving this, right? So we talked about interest rates went up. So cap rates changed, the income created from commercial properties went down, therefore the prices went down and adjusted. Look, interest rates could double from here. We could end up in a radical inflationary environment. Probably not, but if they did, that would be really big headwinds for commercial real estate.
I thought yesterday would be better news for interest rates, and it didn't happen.
Yeah, no, look, I don't think we have the potential risk that we had at one time when we were sitting on 50-year lows. I was telling every client and everybody, refinance, take every bit of cash out you can. Money's cheap. Borrow. I did it myself. I took it out of my house. I took it out of my business. I took my own advice, and it worked really well because I got a bunch of money for long-term cheap. But we told a lot of people also to do that. And I think that there was a real risk of interest rates going up at that time that was, I don't think you can time and predict the markets, and I'm not saying I did. I just said, hey, look, it's crazy cheap money right now. Be a good time to get some, historically speaking. I don't think we're in a situation where there's a whole bunch of historical upside or real risk to interest rates. I don't know if there's a really huge interest rate risk up or down. I think we'll probably see a pretty steady. Now, I'm not predicting and guessing because it's hard, but that's just you have to kind of assess what you think is going to happen. But when you do that and you look at where construction starts have been and real estate deliveries, those are so low that tends to also drive demand in combination with, stabilized interest rates, the repricing of real estate. It makes things look pretty attractive.
It does, and I think that's kind of as you said, bring it to a close here. I think this is a really individual, personalized conversation that ends up having to happen. Yeah. And we look at somebody's entire financial plan and net worth and their appetite for risk, because real estate can be incredibly risky, believe it or not. And you want to be able to assess that risk. Look at the income and the liquidity from a perspective of as much objectivity as possible. Remove your emotions from it. I don't care if you inherited the building 30 years ago. Is it the best thing for your financial plan today, right now, given your situation and given where interest rates are and real estate is? And we would love to help you with that conversation.
Yeah, and let's close on this too, Alex. One of the last slides we brought as a visual presentation, if you're checking us out on YouTube, is kind of the risk associated and the fact that real estate can offer lower volatility. I think it's our last one in there, Brian, if you got it. But yeah, when you look at the historic volatility, this is not a long enough time frame for me, but it's a decent time frame. It's like 2012 to 2025. And you look at listed REITs as a measure of standard deviation. So this is publicly listed real estate investment trusts. The volatility is a 23. When you look at stocks, it's a 20. When you look at bonds, it's a 4.7. And this one fund, again, not an endorsement of any particular fund, but this is a diversified real estate investment fund. The volatility is a 1.9, even through this radical change in interest rates. And we know that this particular TI Plus fund has had a lot of volatility, more than it's ever had. And still, it represents a 1.9 volatility as compared to stocks of a 20. So maybe not only a good potential time to invest, not in this particular fund, not endorsing this particular fund, just saying in general, but maybe it's a good time to invest. But also a great time to diversify your portfolio and potentially lower risk and volatility if you're concerned about what's going on politically or economically or any other thing. So the time is always when it doesn't feel, the time to do something is when it feels like you shouldn't and it's scary. Back to the Warren Buffett comment, be greedy when others are fearful when others are greedy. This is very personal, as Alex pointed out. Your situation is unique. The way you own real estate is going to be unique. We deal with lots of different clients from different facets of backgrounds, and this is where we thrive in helping you understand how this fits into your portfolio and how you can do better for yourself and pursue better financially. So we're going to wrap it right there with this week's edition, talking about real estate, commercial real estate, and all. I'm Jason Labrum with, there we go,
Alex Klingensmith.
There we go. Thanks, Alex. Appreciate you being here, buddy.
Thanks, man.